In ratios, there are lot of parts is there. One of these is a why we do the ratios. Ratios is a one kind of a measurement of the performance of a company, whether they are doing well or not. Just like a thermometer, we check whether our temperature is high or low. So in that way, ratios helps to identify whether the company is performing well or not. So first is the liquidity ratio. What do you mean by liquidity? Means which can be easily converted to cash. So without any significant risk, there is no risk element of losing out the money. So in this way we check out the liquidity, because you have to pay to the creditors, your supplier. So how much cash is there to pay of them? So we call this as a current asset. Current asset means what? Which duration is less than 12 months. You have to pay or you have to collect that money within 12 months, divided by current liabilities. So liquidity checks, ideal ratio will be what? 2 by 1. Obviously your current asset will be 2 times of your current liability, then only you will pay the liability much more easier way. Same way, solvency ratio means solvent. We sometimes say a solvent party. Means solvent party means who has no liability or debt, or huge debt is not kept burden on his lifestyle, so he's free. So in this case we check whether the company is holding any liability or not, so that it can create a problem in near future. Just like debt by equity. Equity means what? Equity means we have told it is the owner's fund, whereas debt means outsider. So I want to find out the ratio between debt and equity. Obviously the ratio, if it is lower, so it is will be ideal for the company to sustain over a period of time. And equity holds what? Share capital. Share capitals means ownership. What we see in the share market, floated number of shares, number of shareholder, and along with that what is there? Profit and loss statement. So whatever the company is earning, how much they are keeping in the reserves, that is also in the under the equity part. And debt is loan, bank loan, mortgage loan, public deposit. So how much they have taken. So ideal ratio will be what? Your debt should be low. Suppose debt is 2 whereas equity is 3, means you have much more money to pay off the debt, so you are a solvent. If it becomes reverse, 3 debt, 2 equity, so you have a huge liability of debt. Turnover means what? Turnover means we generally say sales. One of the example is that suppose you have an asset, and your sales is how much. So obviously I will try, whatever my asset is, suppose I have an asset of 100 crores, so I will be trying to sell 300 crores, so that I can cover up my asset. The more utilization of your asset, it means more sale you are making. Less utilization of your asset means less you are using. Underutilization of asset, obviously from this point of view we can see whether the product has any demand or not, if there is an underutilization of an asset. So company is bearing huge asset but not fully utilizing, so he is incurring that expenses. So turnover ratio, stock turnover ratio means what? How quickly. So stock turnover means COGS, cost of goods sold. What is the cost of goods sold? We have done an average stock. It means what? How quickly. So here the times will be more. This all comes in turnover, always comes in times. So your COGS is say 100 crores, and whereas your average stock is 20 crores or 20 value. So how many times is 5 times? Now if it is a 5 times, so in this way you can calculate how many days it takes to clear out the stock. So 365 divided by 5, so roughly 73 days is being taken to cover up or to clear out your stock. If the times increases, instead of 5, 10, so it will be 36 days approximately. So more the times you are doing, more you are performing well, more quickly you are able to sell the product. Profitability ratio means what? How much you are making profit. We know in class 11 that gross profit is there. Means what? Gross profit, sales minus cost of goods sold is gross profit divided by sales. How much gross profit is there? If the gross profit is more, suppose say it is 70%, so obviously what will happen? Remaining operating expenses, you have a space to make that expenses. Operating expenses means for advertisement, for selling and distribution, for your salary, all for this rent. So all for this you have enough space to pay out these expenses. So more your cost of manufacturing will be less, more your will be gross profit, and more gross profit is there. So for the startup company, what is important? Gross profit. More gross profit is there, then only they can do the sales and distribution or the promotion part, because as we know in today's days you have to make more promotion, you have to keep more money, so that can be possible when your gross profit is more. There are other ratios also, net profit ratio. Due to the time restraint, I am not discussing. I am only discussing about the gross profit ratio. I hope you can get a clear idea or little bit idea regarding how the ratio works.